Hi, I'm David Stein of Money for the Rest of Us, and this video is on why you shouldn't trade, but should be a long-term investor. In the late 1990s, I was invited to visit the floor of the New York Stock Exchange. This was a heady time for the stock market. It was during the internet bubble, and at the time there was a lot of talk about the New York Stock Exchange being overtaken by an electronic exchange called Nasdaq, where most of the new .com and other internet startups listed their stock shares. The New York Stock Exchange was a traditional exchange. On the trading floor, there were specialists, men and women, who were responsible for facilitating the trading in specific stocks. They did this by displaying their best bid and ask prices, executing trades, and assuring a liquid market by occasionally trading their own inventory of stock when there was a large mismatch between the volume of buy and sell orders. I don't remember much about the visit to the floor. I had lunch at the New York Stock Exchange Luncheon Club. I don't think the Nasdaq has a luncheon club, mainly because there isn't a central location where trading occurs. Rather, market makers distributed across the country facilitate trading electronically. Nasdaq was one of the first computer-based exchanges that started to eat into the business of the New York Stock Exchange. Now there are many other public and private electronic exchanges where institutions trade stocks. These private exchanges are called dark pools. And why do these alternative exchanges exist? Because large institutional investors that trade millions of shares of stock want to be able to do so without impacting the price. I recently received an email from a professional trader who has traded oil futures for Wall Street and European firms for years. I mentioned to him I admired anyone who could make money trading oil futures given the random way prices seem to jump around. I've traded commodities and I lost money because it's really, really hard to do. But here's what he replied. He says something really telling. No one can trade oil without customer flow. What he meant was there is a great deal of value in knowing how badly someone wants to buy or sell something and how much they want to buy or sell. An institutional investor who wants to buy millions of dollars of a particular stock will do everything it can not to make that intention known by breaking up the order into smaller chunks and trading on various public and private exchanges. That way, they are less likely to push up the price and signal to other investors and market makers what they're doing. On the flip side, there are many institutional traders and liquidity providers who seek to profit by knowing what the order flow is. It's a game of cat and mouse, and much of it is played out using computers and quantitative algorithms. Ben Hunt, a longtime institutional portfolio manager and currently chief investment strategist at Salient Partners, wrote, as much as 70% of the trading activity in markets today, activity that generates the constantly changing up and down arrows and green and red numbers that retail investors see and react to on CNBC, is just machines talking to other machines, shifting shares around for liquidity provision or millisecond arbitrage opportunities. Financial economist David Rosenberg, commenting on a period of market turmoil, said, the rapid down move in equity prices likely had less to do with fundamental macroeconomic factors and more to do with the vagaries of technical algorithms and program trading, dark pools, and market liquidity. In such a world, individual investors who think they can compete trading stocks, commodities, or currencies are sadly mistaken. They will be outgunned in this global trading arms race. Perhaps in the late 1990s, and I knew individuals who traded internet stocks, it was possible to get some type of competitive or informational edge and turn a profit. But now the reality is there are so many institutions competing with each other for competitive trading edge. They'll often move their trading floor right next to the exchange. And it's these computer bots that are doing most of the trading. And they often can get access to that order flow. They know who is buying what. And the fact is, individuals can be taken advantage of. In the term of Wall Street, they can get their faces ripped off trading. And so it's very, very difficult to do. It reminds me of the closing lines from the 1983 science fiction film War Games, when the supercomputer states the only winning move is not to play. My suggestion as investors, be a long-term investor. Don't try to trade on a daily or weekly basis. It's just too hard to get an informational edge. Focus on asset allocation, asset classes, and saving for retirement. Leave the trading to professionals, most of which actually don't do it very well, because this particular trader I mentioned no longer trades for a living. Now he helps program bots to trade for his firm. So hey, if you like this video, go ahead and leave or subscribe to my channel. If you have any questions on trading, you can leave comments below. Thanks.